Top 3 things to look out for that will indicate a real estate surge in the market. Stay tuned to this week's episode of Prime Property. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Property. So glad you can join us here. I recently had to sit down with a client and we got into a very interesting conversation I wanted to tell and share with all of you guys. We were talking about what are the moving forces that's actually going to cause a surge in real estate prices again. To give you a little bit of context, we both believe that in the next decade plus real estate prices are very likely going to go up, but we always build our portfolio so that we can withstand any crash. So it got us thinking, what are the key indicators that we're going to see in the market that's going to say that the real estate market is going to surge in the next few years? We ultimately arrived at 3 big points, and I'll share those with you today in today's episode. But before we start, please give us a thumbs up on this video and subscribe to the Prime Property channel. It really encourages us to create more content specifically for you guys about the real estate market in GTA. It's kind of like a nice way of saying thanks for all the hard work you put into content like this. So without further ado, here are the top 3 things we should look at. Number 1, stress test change. Number 2, local incomes increasing. Number 3, stagnant interest rates. Now let's all agree about one thing first. The media and the headlines it spits out is 100% going to affect the buyer psychology in Toronto. We know that. Especially in today's negative eyeball-grabbing 24-hour Twitter news cycle. When the buyer psychology is weak, the demand tends to be shaky, guaranteed. So we obviously are not going to include the obvious things such as economic growth, immigration, density, and all the boring stuff in the media's perspective. We're going to be talking about major things that can happen. Number 1, changes to the stress test. Trev recently came out and lightly attacked the OFC for the B20 and the stress test. There have been rumblings in the back for a major reason that the market has slowed down. Don't forget, it's a trickle-down effect when it comes to money. Toronto heavily relies on the extra land transfer tax for revenue, so fewer transactions means less money. Toronto is also responsible for almost 20% of Canada's GDP, so a lot of it is fueled by real estate. So when the market slowed down, everybody feels it. So these rumblings have been saying that there may be some minor tweaks, some changes coming in April to help the self-employed and the commission-based applications. However, a lot of people are just calling it out and saying, hey, look, we need to increase the amortization period from 30 to 40, potentially for first-time home buyers, and potentially reducing the interest rate they used for stress tests. If any of those changes I just mentioned above do happen, you can expect the average capped out market of 800,000 to maybe go to 900,000 as more credit becomes available. That's the first thing I would look out for. 2, local incomes increase. This one we both agreed that when all the new offices open in downtown, all the new tech money is going to start coming into the city, and we're slowly going to start feeling it. There's going to be no like, hey guys, look out for this that the people will be talking about, but just watch out for CIBC Square, Cadillac Fairview, and One University, the office towers opening, and I will show you why it's important. I'll work back the numbers for you. If the capped out amount for an average Torontonian is about 800,000, that means if you divide that by 5, which is how much you can buy with the current mortgage rules, that means the purchasers of an $800,000 property have $160,000 income. Divide that by 2, because 2 people buy, that makes it $80,000 a year. Normal. When the tech money starts flowing in at 6 figures, keyword, starts flowing in at 6 figures. Let's use 100K for example. That's 2 people making 100 grand or $200,000 gross income. That means the purchasing power went from 800,000 to $1 million instead. That's definitely going to change the dynamic of the market as well. Number 3, stagnant interest rates. I followed this fairly closely and it felt like one week the Bank of Canada was all about constantly increasing interest rates in 2019. Then all of a sudden, bam, nope, GDP isn't high enough, no growth, whoop, whatever. And then interest rates are going to stagnate. Maybe even lower, or maybe just stay one increase in all of 2019 at most. News like this gives people hope because what you have to remember is ultimately it's the lenders and the banks that control the mortgage rate. It's just dictated a little bit by Bank of Canada. So recently RBC just dropped their mortgage rates. And don't forget, there's usually a summer rate promotion as well. So I can see at some point maybe our mortgage rates will drop down to 3.1%. Keep an eye out for these things, guys, because that's what I am looking for when I know the market's going to surge. Until next time, guys, happy real estating.